Hello everyone, welcome to my YouTube channel Deep Success. Today we will talk about some economic terms. So let's start the video. Green bonds. Green bond is a debt security issued by an organization for the purpose of financing or refinancing projects that contribute positively to the environment or climate. It is also known as climate bond. It is designed to raise funds specifically for clean energy projects. The companies issuing these bonds commit to investing the raised capital excessively in environmentally friendly areas such as renewable energy, waste management, clean transport, and sustainable land use. The global green bond market has been in existence since 2007 and it is gained traction in India in 2015. Companies, both public and private, have utilized green bonds to raise funds for environmentally sustainable initiatives. Green bonds plays a crucial role in fostering a clean environment, combating climate change, mobilizing financial resources for sustainable investments, attracting foreign currency, and it also help in supporting projects with positive environment impacts. Now, next topic is central bank digital currency. Digital currency is a legal tender issued by a central bank in digital form. It is similar to a fiat currency issued in paper and interchangeable with any other fiat currency. Unlike private cryptocurrencies, CBDCs are backed by the central bank, ensuring stability and trust. It is same as fiat currency and is exchangeable one to one with the fiat currency. A fiat currency is national currency that is not pegged to the price of commodities such as gold or silver. The digital fiat currency or CBDC can be transacted using wallets backed by blockchain. Though the concept of CBDCs was directly inspired by Bitcoin, it is different from the decentralized virtual currencies and crypto assets, which are not issued by the state and lack of legal tender status. The main objective of the CBDC is to mitigate the risk and trim cost in handling physical currency, cost of phasing out soiled notes, transportation, insurance, and logistics. It will also wean people away from cryptocurrencies as a means for money transfer. Now we will talk some important facts about CBDC. Central bank digital currency is that Bahamas was the first economy to launch its nationwide CBDC, namely sand dollar, in 2020. Nigeria is another country to have rolled out e-Naira in 2020. China became the world's first major economy to pilot a digital currency ECNY in April 2020. Important major advantage of CBDC is it enhances security, improve efficiency, financial inclusion, etc. Now the next topic is circular economy. A circular economy is an economic system of closed loop in which raw materials, components and products lose their value as little as possible. Renewable energy sources are used as thinking is at the core. In this circular economy, where the products and designed for durability, reuse and recyclability, and thus almost everything gets reused. A circular economy is the one where products are designed for durability, reuse and recyclability. That means it focuses mainly 3R approach, that is the reduce, minimum use of raw materials, reuse, maximum reuse of products and components, and recycle, that is high quality reuse of raw materials. And it also focuses on refurbishment, recover and repairing of materials. What is the need of for circular economy? Circular economy focuses on minimizing waste while maximizing utilization and calls for the production model aiming to retain the most value to create a system that promotes sustainability, longevity and reuse and recycling. Though India has always had a culture of recycle and reuse, its rapid economic growth, growing population, impact of climate change and rising environmental pollution, the adoption of a circular economy is more imperative now. What is the global response to circular economy is that the Germany and Japan have used it as a binding principle for reorganizing its economy, whereas China even has a law on it. India, when we talk about India, India's initiative to promote circular economy is the 2022 and 23 budget recognized the importance of sustainable growth, and in synchronization with the circular economy, the government formulated Battery Waste Management Rules 2022, Plastic Waste Management Amendment Rules 2022, E-Waste Management Rule 2022. These rules set out target waste disposal standard for manufacturers, producers, importers and bulk consumers, along with enabling transaction among stakeholders for extended product responsibility certificate. And another thing that was included in the budget 2022-23 is action plan, where also formulated across 10 sectors including e-waste, lithium ion batteries, end of life vehicles, scrap metal, municipal solid waste, etc. Now we will talk about AT1 bonds, that means additional tier bonds. Additional tier bonds, it is a perpetual bonds, that means it have no fixed maturity tenure and have high fixed interest rate, but interest rate is usually set high because AT1 bonds are very risky. Investors in these bonds do not get their principal back, however the interest continues forever. AT1 bonds have a high interest rate than other bonds. Due to the perpetual nature of AT1 bonds, these are often treated and viewed as equity, not debt. AT1 bonds are issued by banks in accordance with the direction of the RBI. Financial institutions usually issue such bonds to fulfill their capital adequacy requirement. That is CAR. Capital adequacy requirement, CAR, is an assessment of bank's capital and its risk-weighted assets. These AT1 bonds are contingent convertible bonds, a type of debt instrument that the bank can convert into equity if its capital level fall below the specified levels. This helps the bank reduce debt while managing capital. AT1 bonds have a call option, which allows the banks to buy back the bonds from the investors. These bonds provide high returns but also carry great risk. What is the risk? Risk if the banking institution fails, these bonds are at risk. Suppose the RBI finds a bank in an unstable condition, under pressure, and is in a situation where it demands rescue. In that case, it can ask the bank to immediately withdraw their AT1 bonds without seeking permission from the investors, therefore making AT1 bonds risky. But we should understand what are bonds. A bond is simply a loan taken out by a company. Instead of going to a bank, the company gets the money from investors who buy its bonds. In exchange for the capital, the company pays an interest coupon, which is the annual instrument rate paid on a bond expressed as a percentage of the face value. Now we will talk about what are the base 3 norms, because the AT1 bond are also mandatory under base 3 norms. So what is the base 3 norms? Base 3 norms are set of international banking regulation developed by the Basel Committee on Banking Supervision, aim to strengthen the global banking system by improving the stability and resilience of banks, particularly in the wake of 2008 financial crisis. So these are the important topics which we have covered in this video. So in the next video we will talk about some important topics.